the thing that people are probably most sleeping on in Web3 is the fact that this is going to be the best Web3 go-to-market of all time ever.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Jake, thank you so much for joining me today. Super excited to chat with you. All right, Jake, you are the founder and CEO of CoinFund's. It's one of the world's first digital asset funds. CoinFund invests in both liquid and venture strategies. You guys manage roughly $1 billion in AUM, and you previously worked in quantitative development, Amazon, and an alternative data company. All right, so before diving into nitty gritty, you tweeted recently, 2025 is the first year of blockchain adoption. That's a spicy tweet. You need to tell me, like, how is that possible that 2025 is actually the first year of blockchain adoption?
Amazing. Hi, Andrew, and thanks so much for having me. It's a pleasure to be here, and it's also not the first time I'm on your podcast, so I'm excited to be back. I think 2025 is the first year of blockchain adoption because I think historically, blockchain adoption was said to be a grassroots, bottom-up kind of process. It said that, if we had enough like normal people get enough like Ethereum wallets and go to Coinbase and buy enough Ether and load up our wallets and use enough, DeFi applications, then we would achieve broad mainstream adoption of crypto. Now, I want to say that we have not achieved zero. We have achieved a $3+ trillion asset class. We have achieved about 8% penetration of the world population have held crypto in some capacity. Mostly, about half of that is probably Bitcoin. And we have achieved, some technological progress and some developer progress. But Andrew, this is not mainstream adoption. It's not like your mom and your neighbor and your kids' friends at school are using DeFi. We have not actually converted a lot of infrastructure to blockchains out there in the world. Like most payments still take place in banks, on Swift and so on. We have a developer base which is about 0.07% of the world's developers. When you think about like the iOS App Store and the Google Play App Store together, they put about 100,000 applications into the world a month. And a few of those applications turn into something profitable and good and growing and things that customers like. And we are nowhere near doing that with decentralized applications. We're nowhere near putting 100,000 decentralized apps into the market a month. And so after 10 years of this, I would say that like the piece that's missing from this equation is the broader institutional and enterprise adoption of blockchains. And I also am keenly aware that for some people in our industry, the idea of like giving blockchains to banks is a little bit countercultural, but I actually see it as a huge positive thing. I think that we can achieve a lot more saturation of blockchains in the world if banks and enterprises and Amazon and IBM, etc., start to use blockchain technology. I think that will increase the developer base. I think that they will have an impact on regulation, which we're also seeing this year. 2025 is the first year of blockchain adoption, primarily because one of the biggest bottlenecks that the blockchain industry has had for the last decade, which is kind of a regulatory bottleneck, has been lifted. We are now in a world where, we're possibly weeks or months away from legislation in the United States. We have had a regulatory complete 180-degree turnaround in terms of the attitude toward this industry. There's broader acceptance. There's broader technological acceptance. There's broader regulatory acceptance. And the 2025 is going to be the first year when the enterprise and institutional side will also start to be able to achieve adoption. And I think that we will achieve mainstream adoption when both of those sides can come together and interplay, when retail people will be using more of these products and when institutions will be integrating a lot more of this infrastructure because they now can. And to me, that is positive because the more that happens, the more we can actually try decentralization experiments that are more decentralized rather than less. So that's sort of the reasoning behind my tweet.
And so you kind of see the adoption of blockchain and crypto broadly. It's going to happen through businesses that are utilizing technology to become more efficient and just become, improve their operations and whatnot. And through that process, it'll expose regular folks to products that use blockchain. And that's how it's going to, that's going to be the main pathway of adoption.
Absolutely. There was a time in our industry when, we were kind of looking at the market, like I think like back to 2018 or so. You were around back then, Andrew. And people were saying, yeah, of course, banks will use blockchains, but they're going to be private blockchains or they're going to be permissioned blockchains, and they will defeat the purpose of a blockchain. And like, why are we doing it? It's stupid to add a new kind of database to a bank. I think the reality in 2025 is that a lot of banks think they're going to be on public blockchains, right? And, maybe they'll have permissioned blockchains too in their toolkit for doing certain things, but I think a lot of banks will be able to go on public blockchains, interact with Bitcoin, interact with the Ethereum network, interact with an EVM-based L2, and that is going to be insanely positive for, the mainstream adoption of those types of networks.
But don't you think, building off that question, don't you think that there has to be some sort of, I don't know, sub chain L2, something like that, where if these banks, let's say North Korea hacks, a big wallet that JP Morgan owns, there has to be some sort of rollback mechanism for that, because clients of JP Morgan don't want, it can't even fathom the idea of, oh guys, sorry, we don't have your funds. Lazarus Group just like hacked our wallet with $1 billion, and sorry, so I agree with you. I do think public blockchains are going to be the primary settlement layer, but wouldn't there have to be some sort of guardrails in there for like these institutional players?
I absolutely think you're right on that. I don't necessarily think those guardrails have to be built into the blockchain. Like, for example, if you're dealing with a large corporation that is holding your private data and that private data becomes hacked or exposed, as, in our day and age happens all the time, those companies are liable to you for protecting your data. So I think the same thing would apply if JP Morgan or whoever offered you a product on a blockchain and then like something went wrong. It all kind of depends on, what terms of service you're accepting, like with this provider. And the other thing to say is, I think there's also been a number of proposals and technologies and technological progress that I think makes those situations over time less and less likely. And one of those things is like just making blockchains more secure and smart contracts more secure through formal verification, through better security practices, through better coding tools, through, I don't know, AI generation and evaluation of code. There's been blockchains proposed that actually can do rollbacks or have safety mechanisms where a kind of recourse is possible, smart contract schemes that do that, right? So it all sort of, all these things have been kind of around, but what hasn't been done is that they haven't been integrated into well understood products yet. And the reason for that is we haven't really had that much kind of customers for these things. As soon as the customers will flow, all these problems will become very prominent, and the solutions will, I think, follow in quick succession to us understanding those problems.
All right, I want to move the conversation to CoinFund and CoinFund's business lines. You guys have a venture fund, and within that, you guys do seed, you guys do A and B rounds, because it's kind of that, mini growth, we'll call it. And then you guys do liquid opportunities. Can you describe kind of these different business lines and where you focus your time?
Yeah, so we actually have a seed fund. That's where I spend most of my time and do most of my investing. And, it's been publicly announced our last seed fund was $158 million. And then we also have a Series A and B fund, which is about a $323 million fund or so. And that's led by David on our team, which focuses on slightly later stage, more traction, more product market fit, more revenue, et cetera. And then we have Seth Gins, who leads he's our head of liquid investments and leads our liquid strategy as well. I do a couple of investments in the venture fund. I'm a sponsor there, but most of my work I do in the seed stage.
Very cool. Are you guys doing anything, across like yield or I don't know, we'll call it like GP stakes in funds or secondaries or any of these kind of more opportunistic, unusual activities, or kind of more vanilla?
I would say we're very kind of purist in terms of taking a venture approach and bringing it to crypto. So we don't have like a fund to funds allocation. We are open to yield. In fact, there are certain, like when you're making investments in highly decentralized open networks, there are sometimes ways that we can benefit our portfolio companies by being active network participants. So like we're open to that, but like generally like the vast majority of our returns are created by being early, contrarian, and right in the best companies with the best founders in this industry and keeping it sort of there.
So when you're looking at different opportunities in the seed landscape, how are you slicing dicing it? Are you looking at, okay, I'm really excited about, decentralized AI. Therefore, I'm now going, so I have this thesis on decentralized AI. I'm not going to talk to all the founders there. Or is it more so, hey, we're sourcing all these great founders from our network, and I'm kind of reacting to what I'm seeing.
Yeah. Well, we we say that we're thesis and trend driven, and what that generally means on the thesis side is that we try to be, again, early, contrarian, and right to areas. So decentralized AI is like a great example of that. I think the first investment we made in that category would be World at the end of 2020. And it wasn't like fully obvious yet that there was going to be this huge intersection of, AI and Web3 as it is today. But the second data point in that, kind of 2 points make a line curve was our investment in Jensen in March of 22. And here we met a company with folks who were like from the AI world who were seeing that using Web3 primitives was going to create some like really, really interesting opportunities and products. And then we published our thesis on decentralized AI in September of 22. Now, I think at this point, there must have been like 6 companies in the world who were like looking at this intersection. And we called 3 of the founders and the other 3 called us and they were like, "Oh, I can't believe like you're thinking about this." Um, but the space started to develop from there, and I would say it became consensus in like the summer of 2024. I remember went to Super AI in Singapore, and that was the first conference where like crypto AI people and traditional AI people were, mingling together. And if you look at Cato statistics, I think decentralized AI as a topic represented 30 to 60% of crypto mind share for like most of 2024 and into 2025. So it was quite a confirmation that we were like pretty early to that space. And that's an example of us kind of hopping early onto a thesis, and then that thesis like turning into a trend. So when I think about investing, I'm like, well, what are the 2 or 3 like major areas right now? Well, I'm still doing a lot in decentralized AI. I think there's a lot to do in terms of data, in terms of decentralized AI training, which has been a big pet thesis of mine. I'm also very, very excited about the intersection of DeFi and traditional finance. As I was just saying, I think we're coming into this convergence time when, the financial world, for example, will be starting to integrate these different like Web3 primitives. I think stable coins are part of that. I think what Rob is doing at Superstate, tokenizing equities on chain, is part of that. I think neobanking, we made an investment in Dakota.com recently, is part of that. And then the other big area that I'm super excited about is like finally in 2025, projects like World are showing that we can actually do large scale mainstream consumer adoption of crypto. So World is one in our portfolio, 26 million registered users and growing. Gunzilla is another example, 14 million registered users playing, games on traditional platforms, but also using NFTs to tokenize in-game assets. So those are the 3 areas, decentralized AI, TradFi convergence with DeFi, and consumer adoption that I'm broadly like very, very excited about.
How are you formulating these theses? Are you talking to founders and, you're just like blown away by the drive and intelligence of these founders, and that's giving you the indication that, okay, DeFi, TradFi, these founders in this sector are so amazing. There must be something big here. Or is it more so you guys are putting your heads together as a CoinFund team and being like, all right, what is, what are we seeing have adoption? What do you think is going to move the needle? How is that? How are you guys developing these theses?
I mean, I think coin fund folks do it in different ways. We tend to be like encouraging our team to be generalists, but have one or two areas of specialization. So, for example, George and our team will look at a lot of like stablecoin payments projects, and he's developed quite a, you know, thesis there and knowledge base. Excuse me. I would say I'm like the go-to person on the team for decentralized AI with a couple of my colleagues to help me do those deals. And I think it's a little bit about projecting into the future. Like I like to think that, CoinFund and like what I bring to the table at CoinFund is a technical understanding of a lot of these infrastructural and deep tech projects, which helps me kind of theorize about, what might win or be more prescient in the future. And then it's also a combination of operationally being good. Like one of the goals in CoinFund's investment team is to cover the vast majority of the market. And I think we do, we very deliberately have a process where we actually compute like our coverage rate. We see deals that we missed and like try to understand like why we missed them. And you're never going to get 100%, obviously, because not all kind of opportunities come to market, especially in seed. But it's a discipline. It's a discipline of like very consciously wanting to see all the best stuff in crypto, all the most relevant stuff for us, because we want to be in like the best companies. So having that like thesis building, discipline and kind of this operational discipline of like seeing the market, I think is what helps to do that.
And when you find a group of or a founder or founders building a company within an area that you're really excited about, let's call it, let's say decentralized AI, how are you weighting the different aspects of that startup? You're looking at, is it just like, okay, they're on thesis, so now it's all about the founders, or no, it's like, founders are, we weight that 50%, and then the product is another 50%, and they're already in the market that we like, or I guess where do you weight these different factors when you're looking to make a seed investment?
Look, I mean, the general wisdom in early stages, like team product market. Like when I think about market, I think a lot of people who are in Web3 AI already sort of think it's big, right? For various reasons. So we're already kind of there. When I think about team, the profile of what we've done in decentralized AI looks like traditional AI people who have a lot of credibility in AI. This is because we typically invest in teams that are like solving hard problems. Like Pluralis is it's extending the state of the art of AI by doing model parallel training, as Alex has talked about in various podcasts. And this is not something that the average person is particularly qualified to do. Right? You kind of need an AI PhD. This is not something that a normal person is typically like very qualified to do. It's something that you need an AI PhD to do, and we want those AI articulate founders to like look at Web3 and say, "Wow, that Web3 primitive. If we use that in our project, it's going to make us like incredibly competitive." In the broader world. So like one hypothesis I have is, for example, that, hey, if you do, AI model inference on decentralized networks, hey, maybe that will be like significantly cheaper than people who do it out of a data center. Now, it turns out, Andrew, that thesis is like totally, totally wrong. And that's actually like not the case. Yeah, so so on the team, again, we're looking for AI experienced founders that are coming into Web3 and they're using Web3 primitives to be competitive. And what I was saying is, we might make a hypothesis that, if you're doing decentralized AI model inference on decentralized networks, hey, maybe that's cheaper than doing it kind of the way that, big tech companies do it. And it turns out that that's totally not the case. That thesis would be invalidated, right? Because it actually is more costly to maintain a decentralized network, that can coherently and safely and correctly deliver those same level of results. You have to pay more in a decentralized network to do that. Um, so, that's kind of the profile we look for. And then in terms of product, the way I think about it is, there's a lot of noise and a lot of like different ways that people look at AI. The things that I think that are going to be the most impactful are, can I use Web3 primitives again to like actually advance the state of AI? It's not that I want to give like there's nothing wrong with this. I if you want to give USDC payments to like agents or something, I just don't think Web3 kind of quote unquote on-chain agents today are like very competitive with stuff that OpenAI is putting out or Google is putting out. These big companies who already have so much access to your proprietary like zero party data. But what those companies are not thinking about is like, how do I train a model in a decentralized network? That's a hard problem. That's a problem that requires, like in Pluralis, 6AI PhDs from Amazon to sit down and write a bunch of papers on how to do that. Or like Prime Intellect has shown that you could train a 32 billion parameter model, on a decentralized network, given their scheme. Or Jensen is showing that there's a swarm reinforcement learning that you can do in a decentralized fashion. So what we've done is we've gone from 18 months ago where people are saying this stuff is never going to work. It's impossible. It's too slow. Why are you even like thinking about this? To a world where like multiple companies have this in market and are making fundamental advancements in AI. That's the kind of investment that I think long term is going to be really, really impactful.
When you're doing diligence on, actually, let's kind of build your ideal startup diligence process where you're like, okay, wow, this is 10 out of 10. These founders have, let's call it relevant experience. They're from OpenAI and they're building a decentralized AI thing. They have some early traction that shows their growth is week over week, absolutely stellar. And, their market is huge. Like, what can you give me the green flags of these factors that you're looking at when doing DD?
Well, it's kind of interesting, right? Because if you pull someone out of OpenAI who might be great at AI, like chances are they've spent a lot less time in Web3, right? So the challenge I think with our space and making like those really great investments is catching the people who are bridging that gap. Like by default, OpenAI people are not going to know about token economics. They're not going to know about TGs. They're not going to know about going to market. They're not going to know what it's like to build a community on Twitter for like degens, right? All these things that are like very cultural to the crypto space. So it's always a delicate balance. It's like, yes, you want people who can, I don't know, advance the state of the art of AI or show traction or have connectivity in the real world where they can credibly get a customer funnel into their product. But also if they're like doing Web3, they need to know all these other skills too. So, how do you find that balance? It's hard.
What about red flags when doing diligence? Obviously, there's, this person has no relevant experience. There's like the basic things, but are there any unusual or kind of like not often spoken about red flags when you're doing diligence that you're like, oh my gosh, guys, hey, this person, based on their history or XYZ, clear red flag, we have to skip this deal.
Are you asking in AI or like in general?
In general, just when doing diligence on any sort of startup that you're looking at.
I mean, look, it's hard to be like super, set in stone on this and super prescriptive.
It's hard.
Yeah, like I would say, at the end of the day, um, there's a lot of very different approaches, and some founders get away with like raising money I'm not saying from us, but they get away with raising money without a deck, just on the trust that they build with their, investors. And others do not get away with that. So like, at the end of the day, when the return is created, like everything is great, right? But what are the red flags? Well, I would say, just very, very generally, I think that there's a sweet spot around the number of founders. I think like 2 or 3 founders are great, but like 1 and 4 plus tends to like perform less well for various reasons. I think you definitely want to try to support like early entrepreneurs sometimes because they turn into the best projects and the greatest founders. Um, but there's also something to be said for kind of coming at a problem with uh, with experience in that domain, and that being a really really important aspect of success. So that's why I think VCs like people with kind of a proven track record of whatever it is, exits or at least raising money. Um, I know at CoinFund, especially in this last seed fund that we've done, we've had a really phenomenal graduation rate. By which I mean that the pre-seeds or seeds that we've done in that fund, overwhelmingly find the next round and find a lead investor for the next round. And those investors have been really really great. Like we co-led Pluralist with USV in the seed round, right? Or Founders Fund followed on to Prime Intellect with seed in the Series A, with seed we led, right? And one of the key sort of criteria that might not be like as obvious is like, can this founder raise the next round? Like sometimes, there are ideas that are worth, trying till the very, very end. And that could take 5 years. But what's going to be the difference between the success and failure of that project is whether the founder can raise money, in that interstitial period. So that's another thing that might not be as obvious.
Yeah, and building off that, like founder personality traits that you guys look for or that are just notable, it's also difficult because, if a founder is hard charging and kind of arrogant in some ways, that in some sense can be positive in the sense of like they will stop at nothing, they will keep going. Alternatively, you want the founder to certain founders, you want them to be less arrogant and more charismatic in terms of their or more like, relaxed in their communication with people to be like, hey, you know what, you're right. Here's why I believe this XYZ. And so it's like there is no one rules all personality trait. And there's pros and cons to each. But in your opinion, what are the personality traits that you like to work with?
Well, I mean, I think like as an investor in many of my portfolio companies, I get involved, or at least that's my goal, is to get involved, especially the deals that I lead. As for example, with World, which is a phenomenal deal that we were very early in. I was just over in Toronto and like went on CoinDesk TV and was talking about World, helping them out with their PR and just making sure that everybody in the world was aware of the product and the fact that they launched in the US and the possibilities there. Um, so I tend to work with teams that are great, teams whose products are working. In terms of personality traits, it varies, but it's like, if you're working with someone in a close capacity, are you guys getting along? One measure of that is like, how much is the founder susceptible to feedback? Like there's founders who will listen and integrate every piece of feedback, and there's founders who will integrate none. And I think there's a sweet spot. I think like sometimes they will, and other times they have more information than the investor, and they're better placed to make that decision. So I respect that kind of founder. It's also true that you like don't necessarily have to personally like everyone, on a very deep level. I don't see why that necessarily has to be true to have a productive working relationship. I mean, I used to work at Amazon in an organization of hundreds of thousands of people, and I'm sure like we got along fine at work, but maybe we don't have to kind of hang out outside of work. Um, so like, but I think at the end of the day, the really successful founders will be the ones who, whether or not they're nice people, will act in a professional manner and in a fair manner. And that's a big part of like building trust with your investors. Like, how much of transparency are you giving them? How much trust are you building? Are you saying what you're going to do and then doing it?
When you're looking at different investments at seed, are you leaning more equity, more token, or 50-50? Like what is your ideal structure?
I mean, I think if we're integrating Web3, then, ideally that means there's a token that is adding something very competitive, right? So, um, like I would say in Superstate's case, the fact that you're tokenizing equities and treasuries and different strategies is a really important aspect of that strategy. Like the token sort of is the thing. Now, will they have a Superstate dedicated token? We'll see. Um, or we're also like investors in Blockdaemon, and Blockdaemon is a very like traditional infrastructure as a service company that's really, their main focus is like providing kind of tooling and nodes and infrastructure. Is there room for a token there? Who knows? But I think in the middle, like 90% of deals that we do, I would say it's typically structured as something like an equity investment, potentially with board seats, depending on the stage and so on. And some kind of token instrument, like whether that's an optionality on the token, if the token is created in the future, or whether that token is like a core primitive in that system that will actually capture most of the value long term. I would say that's a big deal. And I'll say one more thing. Why do we like crypto funds over like traditional VC funds? Well, I think the new asset class that we are operating in, first of all, is creating all these like new business models and interesting networks and like ability, like openness and ability for like people to participate in that. And that is all done through tokens. But the other implication of having this liquid asset class is that I think crypto funds can achieve larger returns, and I think they can achieve larger DPI, cash on cash returns to their investors. And I think that's a really important aspect for the LPs of these funds because, DPI has been, I think, harder in the traditional world.
Okay, so on tokens, I feel like in the past, I don't know, we'll call it 6 months, people have been talking about token fundamentals again. It's, it goes in and out of style, as you know very well. But recently it's been all about, okay, tokens, ideally they should be used to, the company should generate cash, and then the company protocol should generate some sort of revenue, and the revenue should be used to buy back the token and burn it, or some sort of mechanism like that. But tokens have basically unlimited design space. You can do so many things with them. In your opinion, and this is a very broad question because it's like, what is the product doing is kind of that follow-up question here. But in your opinion, what is the ideal use case of tokens? Should they be used as these kind of quasi equity instruments to, use the revenue to buy back the token and burn it and drive value? Or is it more of like kind of the Bitcoin style where, oh no, this is an incentive mechanism for a certain behavior we want to drive on this network?
I mean, that is an excellent question, Andrew, and a very, very, very difficult question to answer. I think we've seen some incredibly innovative experience. Like I would say Bitcoin is a like coordination mechanism instrumented by a token, or a large part of why people buy ether is explained by that same mechanism, or like the fact that we used helium tokens to bootstrap a global telecom network that otherwise would take like tens of billions of dollars and is next to impossible, right? Like these are all like very, very innovative use cases that I think showcase some of the power of tokens. And by the way, and on some measures, like Bitcoin is the largest computational network in the world, right? Like it's the largest um, supercomputer by hash power, right? And that's an impressive demonstration of tokens. I think that there's other experiments that we've run that have been like less successful. I think, you know, one experiment is in 2017, as you know, we went through this like exuberance with ICOs as a new form of capital formation. And I think there's like nothing particularly wrong with like forming capital by getting it from community members. In fact, people today do it all the time in these like echo sales and legion sales. And there's definitely like a value to that. But sometimes people say, hey, like this capital formation method will just be better than every other capital formation method, or obsolete like venture capital. And I, now having worked in venture capital, I appreciate why that might not be exactly right. And one of the reasons is like when you're building a blockchain, you're not really building a blockchain, you're building an organization that is building a blockchain. And when you raise money from like very, very unsophisticated market participants who are just sort of there to like hold your token, they're not helping you with this really, really difficult problem. You're running a startup. You're trying to hire the best people. You're building like the best organization you can build. You have to constantly, solve problems, right? Retail participants don't tend to be company builders, but there are professional investors that are. And also, professional investors, like they kind of get a bad rap for like, asking for a discount or something like that. But one of the reasons that discount is there is because they're long-term locked into this token supply. So, like everybody gets their tokens, the traders exit 2 years in, but the investor is vesting with the team for 4 years. And by that time, the 4 years comes around, maybe like the price isn't as good because of a volatile market, right? So to control for that risk, there's those mechanisms. But the point I'm trying to make is that like actually like professional investors are much more long-term aligned with what founders are doing than, the average like retail network participant is aligned with them, who can just sell their token at an opportune time for them. So yeah, I don't know. Thoughts on that?
Yeah. Okay. So I guess that building off that, uh, tokenomics, because I feel like these go kind of hand in hand. But is there a red flag that that you've identified or your team has identified with tokenomics where you guys see something? I don't know, just to make something crazy, but like 70% of token goes to team, something outrageous like that. We're like, okay, red flag. Like, this deal was amazing, and now we can't do it because the tokenomics are so messed up. Or so it's like, is there some major red flags that you've identified within tokenomics? And then on top of that, if you had to go in and fix that red flag, like, all right, guys, can't do 70% of the team. We're going to do the normal 20% to the team or whatever it is. What is like the ideal tokenomics kind of look and feel like? I know there's not one size fits all, but what's like the red flag and what's like the in a perfect world?
I mean, look, tokenomics is another one of these areas that you can design a token supply any which way that you want. I think that you got to do it principles based. So principles is, first of all, like as an investor, you want to make sure that your team has enough incentive to be like really into their project and really like keeping going and getting motivated. So you don't want to like have them own too little of the token supply. Also, when the team owns too little of the token supply and they're being too idealistic that like, no, 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 wait, like the vast majority has to go to the public. And I've been in projects like that, which, um, which there are some, like sometimes down the road, they run into a problem where like they don't have enough token to sell to continue to the next round. And that actually endangers the project. So like one principle is like, you gotta like give the team enough token material to work with to be incentivized and to have kind of longevity. And the other principle is like, you don't want short-term behavior. Like we've had plenty of experiments on this in the ICO boom of 2017 and different like supply economics, but we always sort of converge back to the same thing. The best teams who are going to be long-term successful are the ones who are long-term aligned. And that's why, by the way, CoinFund's been here for 10 years supporting founders, and hopefully we'll be here for another 10 years. We love working with founders who are long-term oriented. So how do you achieve that in a token supply? You achieve that through vesting, very clear, transparent terms of how everyone is dealing with their tokens. And finally, I'll say, well, what is that line of like how much should go to the community, how much should go to quote the insiders? I know there's been this like kind of obvious sounding heuristic that like, well, at least 50% of the supply should go, to the public. And I think one of the motivations behind that kind of rubric has actually been like the lack of regulatory clarity. It has been like the desire of founders and investors to structure the token supply in such a way that they would later be able to argue to Gary Gensler at the SEC that, they're doing stuff that is decentralized, quote unquote, and like fair, and it doesn't fall under a securities regime. But is it really the most effective way of splitting up the supply? Again, I would argue in some cases no, because as I said just now, like 50% of those retail participants are not going to help you build this company. So if there's like a reason why your tokens should be distributed to them, and there very well could be, like for example, in World's ideal is to get out to as many people out there in the world as you can and distribute this token to have like as wide distribution as possible. They think that creates the best customer acquisition on the network of any project, right? But in other cases, we've seen these tokens like be dropped into addresses that make the tokens effectively burned. They're being wasted. Or in other cases, like rewards allocations are being pumped into teams that are not really doing very productive things to, improve the standing of the network. And so it's really a case by case analysis of like, in my network is giving away 50% of the supply, 75% of the supply, 80% of the supply. Is that the right thing for this network to be doing? Well, it depends. And then, and I think it also goes the other way. Like if you're giving out very little and most of it is owned by insiders, and the intention of those insiders is to like flip this token supply and dump on retail, as is the parlance of our times, then I don't think that's productive either, right? Like everyone's goal should be building the best product, the best network, the best team, the best company, the best organization we can. And for every situation, there's sort of like a right way to do that. And you should just do that right way.
I want to talk about a few themes that you are excited about. You keep mentioning World. So did Worldcoin change your name just to World?
Worldcoin rebranded recently into World, and Worldcoin still exists as the cryptocurrency, but the overall project is called World. You have the World app on your phone. You have World ID, which is their biometric proof of personhood. And you have the World Chain, which is an optimism based EVM blockchain that they're running.
Wait, so I am a admitted Worldcoin hater only because of the reason that the orb is spooky. Like I want to give my eyeball to some orb, like what is that orb for?
Yes. I'm glad you asked, Andrew. I have, by the way, an orb. I don't know if you
There it is.
have an orb right here. This is the V2 orb.
Is that actually the world orb?
This is actually the world orb.
Wow.
I'm actually setting it up so I'll be able to scan people who visit me. A lot of the pushback around the biometrics of the orb, like the biometrics functionality of the orb, in my opinion, Andrew, has been like around people kind of misunderstanding or just not being clear about like how it works. So maybe I'll try to do it. You don't actually give your biometrics to the company or the orb. You simply use the orb to take the biometrics, turn it into what's called an iris code, which is a hash of your iris. And this hash, it's one way. It's like once you have the hash, you can't really recover the biometrics. The device deletes the biometrics and sends them to the user's phone. So you have an encrypted version locally, just like you have private keys in your, crypto wallet on your phone. And that's self-sovereign data. That's a very Web3 compliant way of hosting this data. And then once the iris code is kind of in the database and you want to prove your humanity to someone, they don't even send the iris code. They send the zero knowledge proof that you own some iris code there, but not which one it is. And so it preserves even the privacy of that piece of information. And by the way, Worldcoin today is by far, it's not even close. The vast majority of zero knowledge proofs that are verified on chain today is from Worldcoin. Something like over 90% today. Which, all is to say that this is the most privacy preserving biometric proof of personhood that you can buy in the market. You can compare it with some others. There's Clear at the airport. Clear will actually store your iris biometrics in an actual cloud database that they own. They have the onus of protecting it from hackers. They also have a terms of service that say that they might be able to share your biometrics with third parties, just like any startup. And I've heard people tell me like, oh, I was at the airport and the line was very long, and then Clear was like, well, if you want to make your plane on time, sign up. And then I did, and then I gave my biometrics away, and that's that, right? So this is actually the solution that prevents that scenario, right? That's what most people don't understand about Worldcoin. And then, once you have this identity, I would say it is the most credible, decentralized identity play on the market. The app has 26 million registered users. 12.5 million have been verified with the orb. I think we just opened up in the United States. I was at the launch with Sam Altman and Alex Guania just a couple of weeks ago in San Francisco. We're now open in the US. There's 6 flagship stores in the US where you can go and get verified, including Miami, where I live, and also one in Austin, LA, San Francisco, Nashville, and Atlanta. And that's kind of the identity piece. The thing that people are probably most sleeping on in Web3 is the fact that this is going to be the best Web3 go-to-market of all time ever. And the reason is very simple. Like we've had app stores forever. I think in 2015, when Ethereum launched in the summer, I think like we had an app store right away. We've had decentralized app stores for 10 years, but they've never worked for one very simple reason. You need tens to hundreds of thousands of developers on the supply side, and you need tens to hundreds of millions of users on the demand side. And no Web3 app store has ever had that. My proposition is that we will have that in Worldcoin soon. I mean, we already have 26 million. If we're not at 100 million by the end of the year, we're not doing our job, right? Like we will have just opened up in the US. The number of devices will proliferate from about 1,000 right now to about 8,000 in the US. Orb Mini will ship in 2026. Orb Mini is a iPhone form factor device, which you'll be able to do everything you do on an Orb. There'll be like 20,000 orbs in the world. And it works. It's like the user experience is phenomenal. I can single click log into like a borrow lend protocol like Morpho is currently on the World App Store, and I already have some World tokens that have been promotionally like vended to me, and I can try a DeFi protocol, which I couldn't really do before, right? Not without a lot of friction. So I think what will become very, very obvious very soon is that the World App Store is going to be a major channel for like Web3 consumers who want to try decentralized applications.
Wow. Okay. Well, I am no longer a Worldcoin hater, but I still think it's spooky, but I like it now. Thank you, Chick. I appreciate you doing that. All right. So tell me about crypto and compute, because, I've seen a lot of these decentralized compute networks, and that to me has made a ton of sense, because I'm like, man, if you're trying to provide compute to this global AI, usage, being paid in US dollars, maybe you're in the UK and then you got to do the transfer. It's just a nightmare on payments. So sending a token makes a lot of sense. But I guess my kind of pushback on that is, wouldn't it make more sense if they all use, I don't know, USDC or like ETH or just like Bitcoin, like if they are getting paid in some currency that we're already using, versus those decentralized compute networks creating their own token? Or does it make sense to have their own token because they need to bootstrap the network, et cetera, et cetera?
Are you referring to any project in particular? Because I feel like I've seen
like Akash and like some of these more where it's like it's like quote unquote DePIN or hardware, not pure software.
Well, I think I've seen a bunch of models, right? Like if you look at LivePeer, which is also a compute network that uses GPUs, their token is very, very much supply side. It's like you have to use the token to join the network. and to secure kind of your position. It's like collateral to make sure that your node isn't misbehaving or doing something wrong. Whereas when you actually want to buy compute in live peer, you very much use a different currency, right? Um, I think we will see maybe like a resurgence of, hey, can we buy like resources with the native token of the thing? We use Ethereum to buy kind of Ethereum block space and computational power in that block space. There's other projects like we're going to be investors in I won't say the name yet because it's not been announced, but we're going to be investors in a decentralized storage protocol, which does programmable data, right? And so people would pay, again, to execute those smart contracts with a native token. So I think you see like a few models there. I think, when people do GPU networks today, they're very, very AI focused. And I would say it's really what you're going to do with that compute versus the compute itself. I think the compute aspect of it is very like competitive. I think prices are being driven down. I think if there's a shortage of any kind of like high-end compute today, that absolutely kind of goes away over time as more compute supply hits the market. Also, there's compute is like high-end compute is about 2% of GPUs in the world. So yes, big tech owns 90% of high-end compute, but that's only 2% of the GPUs in the world. So there's a huge kind of computational bandwidth to be assessed by going to kind of mid-tier or commodity hardware or consumer devices, right, that are out there in the world. So when I see just kind of these pure plays, I think that tends to be like less of a defensible business than, okay, like I have compute and now I'm going to do something really interesting with it. I'm going to train models in a decentralized way, or I'm going to transcode video 10 times cheaper than Amazon, or, some kind of use case like that.
So on the decentralized AI, I guess what I have heard from some folks and founders is that kind of the primary reason that decentralized AI is so exciting is because we don't want all the AI power and compute and whatnot to be held by a few companies. It's like, well, we want a decentralized network and access to models and whatnot and compute because it provides almost like a safety mechanism for instead of having these three corporates, these gigantic companies own all of that. Is that how you see it, or is there some also like monetary financial reason? Like, oh no, decentralized AI makes a lot of money sense because of XYZ.
I think on average, I mean, like it really depends which issue you're sort of discussing, but on average, I think decentralized AI tends to be more expensive. Like we kind of talked a little bit about like the inference side. I mean, no, I think there's ways of like potentially attacking that problem and making it cheaper. But the fact is, like with decentralized inference, you always need to add a little bit of verification. You always need to add maybe like some privacy primitives and stuff, and you end up paying more for that. What's really, really exciting on the training side is that people have always said, well, I think, well, most people said decentralized training is impossible. Then after it started to be like a little bit possible, people started to say, well, it's possible, but it'll always be a lot more expensive. And I think what we're actually seeing in practice is that, at least this is true, of a couple of our portfolio companies working on decentralized AI training, is that they've both done these uh, experiments where they like run a model training process the traditional way using PyTorch and kind of a data center, and then they run the same exact model process on a decentralized network, and they show that the loss functions sort of like track each other. So, like, we know that there's at least kind of approximate efficiency parity, more or less, right now, and this is very early stages of like centralized versus decentralized training, which is a really, really encouraging early result. So it could even be that like decentralized AI training is not more expensive. But I think, to answer your question, I think for me, like the primary reason why I want to invest into the decentralized AI stack and solve those really hard problems is because I want to see AI be built as a Web3 public good? I think what are in general blockchains and decentralized networks good for? I think I've answered that question for myself over the last decade, and I think it is building public goods that are collectively sort of owned and live outside of kind of government ownership and corporate ownership. I think we can do the same thing with AI. I think that's really healthy in a number of ways. I think it keeps the kind of the science of AI more open and lowers the barrier to entry. Like if you are a scientist, you don't have to go work at Microsoft or something to, try an experiment now. You can crowdfund, some resources, and you could potentially, or you will be able to train your model on the centralized network. I think that's extremely healthy. The other thing is like, well, what is open in models? Well, we say that Llama, Meta's model, is open, but then Mark Zuckerberg goes on all these podcasts and he says, as soon as it becomes expedient for Meta to close them, we'll close them. And even though the weights of these models, you really don't know what data they have been trained on. You don't know what setup they have been trained on. You don't know what hardware they have been trained on. And, when you talk to Alex at Pluralis, he has this really, really great idea of openness, which is to say, openness means openness of setup. It's the data, it's the setup of how you train the model. But then the weights can be closed. And that's actually a good thing from a network perspective because it creates a business model where the network can actually make money. Like no one really wants to pay service providers to inference, stable diffusion 4 or some of these open models because most people can do that now on their MacBook. But when you're training a competitive, frontier, decentralized, publicly owned model, it's actually in the interest of the network to have the weights closed, but the setup open if someone wants to go and compete with you. Just like GitHub, right? It's like I can one click clone your repository. Doesn't mean I will have the same number of eyeballs on that thing. I have to develop my own audience. I have to distribute it and so on. Same thing here. You could clone the model setup, but then you have to provide your own resources to actually like train it and get people behind it. But that creates the optimal competition environment while also having a monetization scheme and also keeping the models open. And I'll say one last thing is some people are scared of AI, but I actually think the more transparent and open it is, the less there is to be scared of because they can be better analyzed. We'll see problems coming sooner. We'll have more eyeballs on the problem, and we'll have like better checks and balances at the end of the day. More power balance around, who owns what kind of model. So I personally think that like openness is the key reason why I am in decentralized AI. And I think it is critical that we develop open models on a competitive level to like the big tech companies, if we want to maintain sort of the checks and balances of the world.
Yeah, I have to completely agree with that. It's we're talking about, potentially in the future hyperintelligence, and if there is a couple corporates that control that, that is a very, it could potentially be a very large issue versus what the future you're talking about, which is more community, hobby is professional driven, which I think, obviously that is a feature that, I would prefer versus 3 or 4 corporates owning the full stack.
Totally. And I'll just say like, there has been multiple instances where like senior executives and CEOs of these big AI companies have come out and said, you know what, like our proprietary models will always be one step ahead of everybody else and will always own the biggest data center. And I actually don't think that's true at all. I think DeepSeek has invalidated that already in practice to some extent. But I also see, and many other people around me do as well now, the fact that we could build much larger computational networks with decentralized networks and GPUs that are not necessarily like high-end GPUs. We can linearly scale them and we can potentially train larger models, just as effectively as this company. So, there's a lot of like evidence starting to mount that open source can win. And We just need to put a little bit of energy and research and into it and put some products into production. And I'm very excited about that future.
Amazing. All right, Jake, it is time for the closing questions.
All right.
Alrighty. So you have to tell your portfolio companies to build on one smart contract platform for the next 3 years. So, like ETH, Sol, like whatever. Like, I don't know. Like you had to tell everyone in your portfolio to build on this network. Which would it be?
Can I split myself in half?
Yeah. Yeah.
That's a very hard question. I mean, look, the general answer to that question is like companies will see a proliferation of platforms and they have to choose the platforms that are right for them. I mean, like this has always been our thesis. When we looked at the blockchain space in 2015 as Ethereum was coming onto the market, like we literally said, our thesis is a proliferation of blockchains, a proliferation of architectures, different trade-offs between these things, and high degrees of interoperability between these things. I do not think that that thesis has been invalidated in any way from 2015 to now. I think that there are some applications that are suitable for Solana. There's other applications that are suitable, for L1s, for L2s. It really depends on what you're doing. If you're running like a sovereign global intercontinent or cross-continental world currency, I think you should be on a dedicated L1. If you're running some kind of more niche business that requires high throughput, you probably should be on an app chain. I don't know, maybe like a ZK Sync Elastic chain or something like that. I think the bottom line though is we have over the last 10 years, we've solved the 3 key kind of pillars that were missing in these stacks. One was scalability. How do we get a lot of throughput? One was interoperability. How do we get our assets to, interoperate between the chains? And 3, privacy. Like blockchains can't just be like transparent ledgers. Like there is proprietary information that needs to be kept. And I think we've solved all those problems. And depending what your application needs, you will be choosing different solutions. But all that being said, I don't think like Bitcoin is going anywhere. I don't think Ethereum L1 is going anywhere. I think we've solved linear and horizontal scalability very, very effectively with L2 right now. I think there's a case for more monolithic blockchains. Like I know some founders who are going for like 1 million TPS, and they're saying, look, if you want to build the next Facebook, the next Google, you got to do it this way, and it's got to have this high transaction throughput. We'll see. There's reasons why I'm skeptical of that, but there could be use cases for that. So Andrew, I can't tell you which one to use. It has to be dependent on what the project is doing.
Very diplomatic answer. I will accept it. Unfortunately, I will accept it. All right. What trend is totally overhyped? What trend is underhyped?
I think most crypto people really don't appreciate the institutional and enterprise adoption angle. Sometimes for fun in the weekends, I'll call up banks and I'll say, hey, like, what are you guys doing in crypto? What are the products that you're building? What's your outlook on the future? And like almost every call that I've had has shown me that, as conservative as these places are, they all generally have a positive outlook. Many, many, many of them have house views that, banks will be on public blockchains. I don't think it's super clear yet, like what the biggest products will be, like whether it will be like customers, holding digital assets in their accounts or, tokenization of stuff or payments with stablecoins. We'll see. But I think like the headline is like, they're all really bullish on crypto. They just need the right like regulatory environment. And when they enter, we'll just have an influx of users. It'll be really great for everyone in the industry. So I think that's an underappreciated view. And I think the overhyped view is like, these like ginormous infrastructure rounds, like guys, we've been building supply side for 10 years. There's some really interesting tech. There's great innovation. We've made a lot of progress. But I think, building the next marginally better slightly faster blockchain or slightly different, interoperability protocol is starting to be a little bit less valuable at the margin, because what we need now is customers. We need product market fit. We need to go to mainstream users and really like resonate with them, educate more people about how to use these things. And until that happens, I don't, I think those things are kind of overhyped.
Love that. All right. How has being an entrepreneur slash fund manager changed you as a person?
Ooh, um, it's a certain lifestyle for sure. A lot of travel, dedication to the team. Um, I really like this industry because my brain, first of all, loves technology, loves finance. It's the reason I'm here fundamentally, is that this is the best intersection between technology and finance ever. But it's also like the kind of technology that gets applied in all these different areas. Sure, we've talked about finance and we've talked about um, you know, um, like blockchains and currency and like DeFi and all these things, but we've also seen architecture. We've seen, you and I, Andrew, have seen digital assets, people trading cats on the blockchain, just all these like different areas, and people from those areas congregate in the space. And that is what keeps me going. Like my brain needs constant stimulation, constantly seeing new things. I don't think there's a more creative space than like crypto, blockchain, decentralization technology. And it will be sad when we specialize more and it'll be more boring, actually. But you know, it'll be fine. Um, and I guess like I've had a lot of like learnings too, and like at the end of the day, this is gonna sound really trite, but it's trite because it's true, which is that like at the end of the day, your startup, is as good as like the people behind it, and the people are only as good as like you can bring them in and teach them and manage them and empower them, and they can grow into like leadership roles. So it's like, especially as a manager who, fund management is like very much a people business, dealing with LPs, also dealing with founders and portfolio companies. And so I think those are the dimensions upon which I have grown the most as an entrepreneur.
I love that. All right. What is one piece of advice that you would give yourself before launching your firm? So before launching, you could say, this one tidbit of advice. What would it be?
I mean, self-critically, if I were to do it all again, I would probably hire marketing much sooner, and I would hire people much sooner.
Did you go a few years or did you go a long time thinking, okay, I can run every aspect of the business? Or what was that? Where did that thought arise from?
Well, I think in our case, it was a combination of like us starting from like literally scratch. Like, I started CoinFund with $5,400 worth of Bitcoin. So some of it was like not having like resources to hire everyone we need to hire. It was a journey. Another part is just like some things were in our sphere of expertise, like deep tech and blockchain tech, but marketing was less so. And I say that also as like, kind of the most followed member of CoinFund's on Twitter and so on. But like, just getting those professional people wasn't on the menu in those early days. And if I were to do it all again with resources, I would certainly like push the gas pedal more on that.
Awesome. All right. Last question. Is there a piece of content that had a major impact on your life, whether it be like a book, a movie, a podcast, or even like some series of shows or, podcasts or whatnot that had a big impact on you?
Like in crypto, I always think back to this one talk by Andreas Antonopoulos, and I believe it is called The Future of Bitcoin. And I believe it was either from like 2014 or 2015. But in that talk, he describes how we have this inevitable future of token proliferation, which I understood as blockchain proliferation. And as I said, like that always like resonated with me and was always like the backbone of everything that we did and how I invested, in the space. Like you kind of have to have a model of like, what do you think blockchains will do in order to like build models of what will happen in the future. And so, if you thought that like one model would take everything, and everything would just be on Bitcoin, that would be like one future. And if you thought that like there'd be millions of blockchains, that would be a very different future. And so, I think that talk really influenced me into like the blockchain proliferation and reinforced that feeling that I kind of already had. And that has been an important, way in which CoinFund was right about the market. It's one of the things that enabled us to be here today.
Amazing. All right, Jake, where can people learn more about yourself and connect with CoinFund?
X.com, JBRUKH, follow me. And also CoinFund is COINFUND_IO.
Amazing. Awesome. Thank you, Jake.
All right. Thanks, Andrew. Appreciate it.